Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
That I was talking to a client just the other day, and it was funny because she has two different setups, two different portfolio strategies, two different accounts, two different portfolio strategies. One is an aggressive, one I call the Warren Buffett way of investing. It is you put your money in the market and you wait. You dollar cost average, you systematically add more money to the account and you wait 40 years, 50 years. That's what Warren Buffett says. The other is an income model, a pay me model, and she was pretty unhappy about one of the portfolios. Over the past few years, markets have done real well. And so she was pretty unhappy with how one of the portfolio's strategies was doing. So we had a conversation, we talked about it, and we went over how the two accounts had worked. And it may surprise people which strategy did better. One was a pay me an income model when rates have been zero the last 4 years, and one is an index strategy where people think markets have done these phenomenal numbers over the past 4 years. I'm Daniel Agemy.
And I'm Andrew Agemy. And you're listening to Financial Strategies with Andrew and Daniel Agemy. Welcome. Is time in the market or time in the market? Well, we're glad that you're joining us. And Daniel, that's a great thing to be asking, right? Time in the market. Big rhetoric out of Wall Street, right? This is part of the Wall Street's phrases that they use to get people to stay in the market so they can make more money off of people's money, right? Oh, it's timing the market will do it. Or they come out and say, oh, it's not timing the market that counts. It's time in the market that counts. And is that really true? Well, I know the rest of the story here, what you're going to say. So tell us.
So we went through the two strategies, and rates have been at zero, right, for the last 4 years, essentially.
Yeah.
And so in the income account, she had done 6.25, if I remember properly, averaged every year.
And net of fees, right? That's what she actually made.
Yeah.
Okay.
And she was like, wow, okay, that's not so bad. And then we talked about the indexing strategy that she had been adding more money into out of her pocket.
Yeah.
And that one had done something like a couple of percent. It was not anything to brag about. And
Wow.
this is markets. It's Warren Buffett's way, like I said, low cost indexing strategies, basically no fee, internal fees on any of the funds. You just dollar cost average in. But it's the magic of compounding, right? Yeah. What ended up happening with the income portfolios that paid her, she didn't add any money to the account. The investments paid her and reinvested. And that's how it had done so well, even though rates have been at zero. And in the other one that she added money to, it did not do that, because on these index strategies, the Warren Buffett method, you can't look at it in 4 years. You can't look at it in 3 years. You can't look at it sometimes even in 10 years. You have to wait, he's
40
90-something years old. You got to wait your whole lifetime. That's the difficulty. And that's why in 401ks, especially, it's 40 years. It's your whole work career. And that's what people's accounts have done well. If they actually went and looked at the actual results of what you earned each year, they'd probably be a little disappointed. But because the money comes out of your paycheck and it starts compounding, it starts adding up over time, and then it's your whole work career, and you're like, oh, look, I've got some money. It's a good forced savings, but people have a difficult time waiting, right?
Right.
10 years, 15 years, 20 years, 40 years, in Warren Buffett's case, 60, 70 years.
Right. And especially if they're retired or close to retiring, they can't wait anymore. That's what I mean. That time is behind them. Time in the market. Well, that's for a 20-year-old, 30-year-old, 40-year-old, right? People my age or older or whatnot. It's time is behind us. It's not in front of us. So, good point.
And these investors say things like at my age, we don't want to be I hear our clients, our prospects, people we talk to say these things all the time. At my age, I don't want to take on that risk. I don't want that. They intuitively know this.
Right.
And so what she did is she said, I don't want this index strategy anymore. I don't want time in the market.
Mm-hmm.
I want to get paid. And so we switched the strategy over to the way her other account was. And now
sweet.
It will pay her every single year.
Yeah.
Markets go up, it will pay her. Markets go down, it will pay her, and she'll be able to reinvest it actually at better rates if it goes down. So going down will benefit her. If it goes sideways, she gets paid. And so it's a pay me model instead of a time in the market.
Yeah.
Yeah.
Pay me. I love that. I love getting paid, right? Who doesn't like their paychecks, right? Who doesn't like to get a check from the government that was not expected, like during COVID or whatever the case may be? We all like to get checks, especially the less we do to get a check, the more we like it, right? Sometimes is what it feels like. And so that's what's happened. That's what you're talking about. She's putting her money to work instead of having her money sitting on the beach sipping pina coladas in the indexing strategy. She's putting it to work in a sweatshop so that it can actually make her money. And that in that example, that was well over 200% more she was making over in the indexing. I mean, than in an indexing strategy. So that's fantastic. Well, if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is timing the market or time in the market. Well, we're glad to do that. And going along with today's theme and today's title, we have a paper we'd love to put in your hands called Hard Lessons of Stock Market History. I mean, if we look back at the stock market, we see certain repeatable and predictable trends that happen in the stock market that Wall Street does not want you to know about. This paper will explain that to you. And we'd love to put it in your hands so that you can educate yourself and know things that Wall Street knows, but they're not telling you. So you can have that paper by calling 800-725-7616. Ask for the paper on Wall Street history. And we'd love to get that out to you. 800-725-7616, or try us on the web, agemy.com, the two words AgeMy, spell our last name of Agemy.com, and ask for it on there. Or check us out if you ever miss any of these radio shows or want to see one of the ones again or whatnot, they're available on YouTube or anywhere that you listen to podcast on. So check us out there. Daniel, that's these two views, right? Timing the market, timing two major, very old adages that come out of where? Wall Street, right?
Right.
Why does Wall Street propagate this kind of propaganda?
It's about money. Each industry, right? Whoever's listening, stop and think about this. Think about the industry you're in, and right? If you're in the medical industry, if you're in the food industry, whatever industry you're in, that money talks. So the biggest firms, not necessarily the best, right? The ones with the money get what they want. They lobby and they do legislation and they do all these things so that they can get the thing that they want passed. Pharmaceutical, hospitals, whatever it is. And Wall Street is the same. So these companies like Vanguard or BlackRock, who have these huge passive strategies, they are there trying to get you to keep your money in the market. That's the time in the market.
Right.
The longer they keep you in the market,
the
more they earn. Now, if you're not in a pay me model, then you can have these long periods of times where nothing happens. We use the example of the 13 years from 2000 to 2013, where if you had $100,000 in a passive fund, 13 years, and you had no fees and you were not adding any money, 13 years, you would have a stomach wrenching 50% drop. You'd recover, another stomach wrenching 60% drop, recover, and 13 years you'd make zero money. Now that's assuming you didn't sell in either of those drops. Who wants 13 years of nothing? This is not a one-time off thing, right? Because we're talking about market history today a little bit. This is not a one-time thing. This is just the most recent thing.
Yeah.
So that's time
Yeah.
in the market. But who gets paid that whole time? Because there isn't an index with zero fees, right?
Right.
Even the
Right.
cheap Vanguard, the cheap BlackRock ones, there's a small internal fee. So they're getting paid
Right.
that whole time.
Uh-huh.
And then you have timing the market. And
Right.
this is managers that want to try to beat the market. And they may
Right.
or they may not, but they're also doing it to collect a fee, right?
Mm-hmm. Right.
They may be worth it, they may not be worth it. The
Right.
difficulty is which of these do you want to do?
Right.
Time in the market or time in the market?
Right. Exactly. And but you don't have to choose one or the other. There's actually a better way that we're going to be getting to. And Daniel, I like how you set that up. Thank you very much. But here's the big key, folks, is Wall Street makes money if the market goes down, if the market goes up, if the market goes sideways. Unfortunately, you only make money, generally speaking, if the market goes up. So their goal is to have as much of your money in the market for as long as possible so that they can make as much money as possible. So they come up with adages like timing the market, or it's not timing the market, it's time in the market that counts. Or, oh, don't worry, it will come back over time, right? But if you're retirement age or close to retirement age, time is behind you, my friend, I'm sorry to say. And the good news is today's the first day of the rest of your life. And unfortunately, you're younger today than you're ever going to be again. So you got to make sure that the older self is taken care of as well as the younger self. So you're listening to Financial Strategies with Andrew and Daniel Agemy. Today we're giving away a book, Financial Insanity, right? How to keep Wall Street's cancer from spreading to your portfolio. This is what I'm talking about when I'm talking about, Wall Street wanting your money in the market for as long as possible to make money on your money. And this book will help you be able to understand. It's an easy read book. If you're a slow reader, it's going to take you 3 hours cover to cover to read this book. This book is out of print, but guess what? We have some in our possession that we'd love to be able to send you a free copy. So you can have your copy, Financial Insanity, understanding how to protect your money, how to be able to make money in this market, and have it by calling 800-725-7616, 800-725-7616. The first 5 first-time callers at 800-725-7616. Call now.
This is Financial Strategies with Andrew and Daniel Agemy.
So Daniel, I'm thinking of one of our new clients. I'm going to call this person Jerry, and I'm changing the scenario here to protect the innocent on this. So we always change names and things like that. So Jerry is a new client. Jerry is retirement age, but still's got 5 years or so before Jerry's going to retire. And Jerry came on with us because, like most people of retirement age, they say, I am not as aggressive as I used to be in regard to my investments. I want to be more conservative. And Jerry, in particular, was involved with a travel industry and a travel club. And we're going to call it that it was a hunting club. And Jerry would go to Wall Street and meet with these guys from Wall Street companies about this hunting club that he was heading up for his travel industry. And Jerry said to me, Andrew, I've been with those guys on Wall Street, and I know they don't care about me or they just want my money. They don't care about me. They have no interest in me as an investor in what they're doing. They just want my money. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about timing the market or time in the market. And AAA, this is a true story that you are talking about. This is somebody who was with the Wall Street people on these hunting trips and heard their conversations, their real conversations about work
behind the scenes. Right. Exactly. And so Jerry picks up on, when they're talking about timing the market and time in the market, and oh, it will come back over the long haul, recognizes that's not the case. And then Jerry, in the past 4 years, when the market had done so phenomenal, had made minuscule amounts, just like that example of that other client that you said with the 2% every year. That's kind of more in line with what they've gotten. And so now, they're getting, in the 5-6% range net at this point. Now he is with us from that standpoint. That's pretty exciting from that. But the cancer that Wall Street has, and the idea that, oh, time in the market or timing the market. And the problem with timing the market is that you're never going to buy at the whole idea is buy low, sell high. You're never going to buy at the bottom on purpose. You're never going to sell at the peak on purpose. And you never know where it is. Like even right now, the market is down, maybe 15%, 10 to 15% or something from January 1st of 2022. And so the market is low, but from where it was then. But is it going to go lower, or is it, are we at a low spot and it's going to go higher? Well, we don't know exactly where things are right now, but we do know that overall we're at all-time highs, generally speaking, in the stock market. So the question was, do you keep doing the things, we're giving away this book today, Financial Insanity. What's insanity? Doing the same things the same way, expecting different results. And, so people, when they're in retirement, age, they can't do same things the same way, expect that their retirement's going to be taken care of, because it's a different deal. They have to do things differently. So, this whole thing that Wall Street has is crazy. And like you say, Daniel, if you're talking, 25, 40 years of being it and not having to take your money out, that's one thing.
Yeah.
But if you need money to live on or have to take it out because of required minimum distributions, well, that's not going to work. That's insanity.
Or if you want to live, you want to live, you want to take your family on vacation, you want to go on vacation, you want to enjoy life. Like this is something you and I have been talking about quite a bit lately, where like joy, like what are you waiting for to have your joy? Like, you're going to wait until your portfolio grows to a certain number? Are you going to wait until you retire? Are you going to wait until somebody's a certain age? You're going to wait till your spouse retires? Or you're going to have joy? You're just going to have joy now. And, when you're talking about the pay me model, it allows you to have that joy, because you don't have to worry about like, well, we're going to take 2 years off because markets are down, and then we'll have joy again. We'll start traveling again after these 2 years. And to hop back on what you were saying about like markets being expensive, this is something like if we talked in, 2018, or we talked in November, August, November of 2021, maybe stocks look cheap compared to fixed income or bonds. Now, there was always deals that you could get in those, but maybe they looked cheap because they had upside, and like a 30-year treasury was paying what, 0.5%, 25 basis points, whatever. Like, you can't really make anything. You have more downside than upside. But now when we look at it, it's completely reversed, where almost every metric you look at stocks, especially US stocks, we're talking US stocks here, they look expensive. They've come down tremendously. They still look expensive on every metric, but you could earn 5% in a 1 year US Treasury. Like, okay, so if markets are averaging, 7 to 9%, whatever metric you want, over 150 years, and you could get 5% in a US Treasury, and stocks are all-time highs by not all time, but they're at their 3% of all-time highs. By every metric that you use, they're expensive. What are you gonna gain? Are you cool with, like, we'll use the 9% number? Are you cool with getting a 4% spread over a treasury, but you have this huge downside potential? Like, that doesn't sound like a good, we talk about risk return. That does not sound like a good risk return metric to me.
Right. That's a very good point, Danny. Risk versus reward. What's the risk versus what's the reward you're getting for it? When treasuries are 5%, risking money to make, 2 or 3, maybe 4% in your example, is that really worth it? Where you could lose 50%, but you could make maybe 4% more than a treasury where you don't lose anything? That's kind of crazy. Well, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is timing the market, time in the market or time in, let's try it again, timing the market or time in the market, right? That's the question. But is that really the question? So we've got a paper that we'd love to put in your hand today. It's called Hard Lessons in Stock Market History, because we believe that, like the saying, right? If you don't know history, you're doomed to repeat it. So learn from the mistakes of others from stock market history, because there's certain repeatable and predictable trends. There's things that you can learn to be able to invest your money and make money through all kinds of markets. And so we love to be able to put this paper in your hand, Hard Lessons in Stock Market History. So call it, ask for it by name, Stock Market History, 800-725-7616. Stock Market History, 800-725-7616. Daniel, risk versus reward. People don't always look at what that means, and they think that, well, if I don't do any risk, I can't make anything. But they don't understand that there's risk is on a scale of 0 to 10. And typically people think of risk only in the maybe 6 or 7 to 10 range. And so they think it's 0 or 7 or 10, right? When there's a whole 2, 4, 4, 5, 6, in between there that they can invest in to have lower risk and better returns, which people don't understand. That's what this show is all about, is helping people know what they don't know. Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. And that's what we're trying to tell them.
Yeah, I like your casino analogy with the risk and return, because that's what ends up happening. And like I also, oh man, we could go all different directions. You said people who do not know history are doomed to repeat it. And that makes me think of Ecclesiastes, right? Ecclesiastes is all about there's nothing new under the sun.
Right.
And there's not. Markets just, like, human nature does not change. Like, we have new technologies, we have different technologies,
right.
But we've always had new technologies. We've always had different technologies. It's going from the Pony Express to the telegram, right?
Well, the wheel was a technology, right?
It's the train. Like these things, it never changes, and humans stay the same. And there's nothing new under the sun. So you can learn a lot by looking back. And like, we're looking at charts right now, go back to the 1800s of the S&P, and people say stuff like it's time in the market because it always goes up and to the right.
Right.
And that's true if you invested in the 1800s and you kept your money in there and you didn't freak out in the 84% drop in the Great Depression, and you didn't sell it in any of these other times, and you were alive since the 1800s. Yes, it always goes up and to the right. That is time in the market. The difficulty is these long stretches, 21 years, 17 years. We talked about the 13 years in most recent history where nothing happens. And are you going to put your joy, are you going to put your retirement, are you going to put your traveling on hold through those times? Or are you going to look at other options that pay you, right? That pay you. And those can be stock market type of things, but like, that's flipping back again to that risk reward. And like, are you going to buy stocks that are, by every metric, in the top 5, top 3% of all time highs? Definitions are important, because people say things, they like to say things like, I'm aggressive, we need to be aggressive. Well, what does that mean? You're going to be aggressive to earn 7% when you could be in the moderate and earn 7%? How does that, why would you do that? You have a 50% downside potential because you want to be aggressive, but your average is 7% and you could do that in the moderate. If you're going to be aggressive, be aggressive. Take a risk that you can make multiples of your money, not 7%.
Right. Right. And then that's a great thing, Daniel. A lot of people invest in bond funds, which are still aggressive. They don't understand how they're aggressive. And I'm like, don't invest in bond funds.
Yeah.
That's aggressive. You're not going to make much money in there. If you're going to be aggressive, invest in something that you can actually make some money should the markets do well, if you believe in that. So anyway, we got today's book we're giving away on financial strategies and Andrew and Daniel Agemy, because people don't know what people don't know. We have Financial Insanity, written by our friend David Scranton. This is his first book. It's now out of print, but we have some copies for you. And the first 5 callers at 800-725-7616 can have it. First time callers, 800-725-7616. Ask for the book, Financial Insanity. Call now.
This is Financial Strategy with Andrew and Daniel Agemy.
Hey, this is great. I have a friend in that's out in Tulsa, and he's got a lot of clients who are farm oriented. Not all of them, right? Not everybody in Tulsa is hick, right? Not everybody is a farmer, right? Or but nevertheless, he came up with this thing, which is great, right? Which is said, farmers, they have a plot of land and they can get X amount of crops out of that land. Now, the lot or the land next door to them, the acreage next door to them is for sale, and they can take some of those crops that they did, the money from some of those crops, and buy some more land. Because when they buy more land, they can put in more crops, and then they can get more money from the crops, and then they can buy more land and get more crops and get more money from the crops and buy more land. And then at some point, they can just work the land that they have and just get money from the crops to be able to pay them for the investment of buying that land. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about timing the market or time in the market, and which is the proper way of investing. Which is the proper way, AAA?
Well, I want to get paid, right? If I'm that farmer that buys that land, and then I get income off the land from the crops, right? Especially if I lease it out and somebody else is working the land, right? I don't have to work the land. I just get the money from the crops, or part of the money from the crops. Then that's a great thing, right? Because you talk about passive income. I'm not doing anything, but I'm getting this income. Plus, I own the land. So now, maybe the land's worth $1 million, and then I buy the land next to it and it's worth $1 million. Now I got land that's worth 2 million. Or better yet, I buy land that's worth $1 million, but I mean, it's a $1 million land, but I'm able to buy it for $800,000 because nobody wants to buy land. And I'm getting the same amount of crops from it. And then eventually I'm getting, not only am I getting the crops, but now eventually my land is worth $2 million, but I only spent 1.8 million on the land. That's a beautiful thing. I love getting paid.
That's cool. That's a good analogy. That's and you don't care, okay? You don't care
Right.
that your $1 million property is worth 800, or you paid 800 for it, or it's on your books at 800. You
Right.
do not care because it's still generating the same amount of crops. You're still
Exactly.
getting paid the same amount of money. And so you can wait for it to come back to the million or the
If I
million
want to
five,
sell
or
it.
if you want
Yeah.
to sell it, or you want to mark it up on your balance sheet, or whatever you want to do. But it
Right.
doesn't matter to you because you're getting the crops. And you're earning the money on the crops, which allows you to buy more land for cheaper. So it actually benefits you if that land is undervalued, because
Right.
now you can go buy other people's land with the money you earn from your crops, right?
Right.
And that's
Exactly.
the eighth wonder of the world, right? The eighth
Compounding.
wonder of the world,
Yeah.
compounding interest. And that's you're talking crops, but if we switch back over to money, that is your money earned you money,
Right.
and the money you earned is now earning you money, and the money you earned is earning you money, and the money you earned is earning you money, right? And it just
Right.
continues to go on and on and on. And now the amazing part about that is you can flip it on
Yeah.
whenever you want. Going back to the original story with the client, we talked about one account she was investing money in, one account was reinvesting because it was paying her, and those she doesn't need the money, it was reinvesting, and her money was earning her money. Well, one day she will call us up and she will say, I don't want that to reinvest anymore. I want it to pay me. And we will flip it on and it will start going into her bank account and she will start living off of that money. That's the amazing thing. It doesn't matter if we're in a down market. It doesn't matter if we're in a sideways market. She can call us up and we will flip that on and it will start paying her.
Yeah. And, Daniel, what I think about is, so she's going to do that when she retires, right? She's going to call us up, say, hey, I'm retiring. I need this money now. And we'll turn it on. But, the thing that I'm reminded of is, that Wall Street wants you to think timing the market or time in the market is the key or over the long haul. But, that doesn't work. And so there's other ways of achieving that through alternatives, the alternative style that you make money no matter what happens. Where Wall Street's making money when the market goes up, down, and sideways, well, you can too if you do things other than what Wall Street tells you to do. I mean, that works well for 20 people, 20, 30, 40, 50 years old, but people who are 50, 60, 70, 80, 90 years old, well, now it needs to be a different thing. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is it time in the market or time in the market? Which is it? Well, that's the whole point that we're getting to today, because people don't know what people don't know. So we want to help you understand things that you're not going to hear from Wall Street types. So we have a paper that we'd love to put in your hand. And, this is called, this paper is called Investing for Income in the Stock Market. Income in the market, dividends and interest in the stock market, and other ways, right? That there's ways to be able to make money now, but you have to know how to do that. Many times I see people investing in investing, and their income is going to pay the fee to the people they're investing with or to. And that's egregious. That should never happen. You should make more than the people who are investing the money. And we want to give you this information so that you can understand this, either do it yourself or get somebody to help you in whatever ways. But there's ways of making money in the stock market. There's ways of making money today, but it's not the traditional fashion that you think of tradition. It's the alternative fashion. So we have this paper, Investing for Income in the Stock Market, calling 800-725-7616, or checking us out on the web, agemy.com, the two words age, my spell our last name of Agemy. Daniel, people are, the first part of this show, we're talking about how, it's not timing the market. It's not time in the market. You can't time the market. And, the question is when, you got to buy low, sell high, but when is low, when is high? So how do you time the market from that aspect? Secondarily, people have lost a lot of money trying to time the market, haven't they? And, with that time in the market, the same thing. Well, we don't have time. Time is not, for the person who's, 50, especially 60 years old and older, time is not on their side as far as investing with that goes. So there's ways of investing that are seen as old school today. Is what people did in the 50s and the 60s and the 70s, right? It's before the people became enamored with the stock market. A lot of people retiring today, they're baby boomers retiring, and they got enamored with the market because in 1982 the market was at the Dow was at 700 in 1982, and by the year 2000 it went up dramatically from that standpoint. And, so from that, people are enamored with the market, thinking the stock market is where you make money. Well, it can be during certain times, and that goes along with the paper we gave in the first half of the show. But it's not always. And now, especially if you're in or close to retirement, you have to do things differently. And, in my mind, Daniel, there's no school like old school.
Yeah. Yeah, you have to be very patient and you have to have a lot of time, right? To be a time in the market. And then timing the market, we've talked many times about how JP Morgan has done this study where they look at individual investors and the market has averaged, I'm pulling up, like, trying to remember the numbers from the study. Markets have averaged 7% a year in the 20 years that they did it in, and the average investor had done 2 or 2.5%.
Right.
And it's because they're not patient,
right?
And they're not waiting the 40 years like Warren Buffett, and they're trying to time it, and timing is extremely difficult, and that's why they do earn 2% instead of the 7% average. But like people have a hard time waiting 20 years to get the 7%, right? Right. And
well,
I
they have
talked to
time
somebody.
waiting 6 months sometimes,
Absolutely. No, I talked to somebody yesterday, and she said, I have a friend and they get 7% in an index fund. And I said, that's what people say, right? That's what this JP Morgan study said. 7%, but that's over 20 years. It did not do 7% any year. Not one
Right.
single year did it do 7%. It
Right.
did nothing for 1 year, and then it did minus 10, and then it
Right.
did plus 20, and then
Yeah.
it did minus 5, and then it did
Yeah.
plus 2, right?
Yeah.
It did. So that's the time. You have to commit time in this strategy. And you know what I say? Time in the market or time in the market? I say get rid of both. Don't do
Yeah.
either. Make your
Right.
own rules. Get paid, right?
Right.
Make your own
Exactly.
rules. And there is a different way to do this. And that's what you've been talking about with the strategies. And there's another interesting thing going on right now, too, that people have forgotten about because it's been so long since we had inflation.
Right.
How do you protect yourself from inflation?
Right. Oh, the
People say,
stock market. Put it in the stock market.
exactly. Well, they're all-time highs, and you could hope they keep going up because there's a money printer, and the stock markets do what the money printer does. So you could hope that happens. That's not a retirement plan. Hope is not a retirement plan. You
Nope.
can hope that happens,
Yeah.
but we talked about the risk return.
Yeah.
And you might not care. You might say, well, I still want the 4% spread.
Yeah.
I want the 5% spread over the treasury, the 4%, the 3%, whatever number you use the 7% or the 9% average, right?
Right.
So you got a 2 to a 4% spread on top of treasuries. So you don't care. You're like, I'll take that. I have a downside 50%, downside 40%, and for that 4% average a year spread over the treasuries, I'll take that. Well, guess what? There's a lot of smart people that are not going to do that. And do you know what will happen when they don't do that?
You lose money.
They're going to pull their money out of the S&P index funds and put it in
Yeah.
treasuries. They're going to
Yeah.
pull it out and go into good dividend paying stocks, especially international dividend paying stocks that are cheap, that will
Yeah.
protect you from inflation.
Yeah.
What's going to happen to your index fund? It's going to come down. And you took that weird risk return ratio, but they didn't. And it affects you because you're in a fund, right? Same
Oh,
way you were
yeah.
talking about the bond funds. It affects you. You didn't
Woo!
sell any of your bonds, but the fund manager did because Joe wanted liquidity. And so they
Right.
sold your guarantees. They sold your bonds in the bond fund, right?
Yeah. Yeah, people don't know what people don't know. That's why we have Agemy Financial Strategies with Daniel Agemy. So, Daniel, that's an excellent point, and I want to talk more to that. When we come back from break, but we're having a good time today and just going through this really fast, right? But we got this book for you and our listening audience, Financial Insanity, written by our friend David Scranton. Easy read book. We'll talk a little bit about stock market history, why Wall Street wants your money in the market for as long as possible, and why you're not hearing about these things that you're hearing about on this show. So you listen to Financial Strategies and your Daniel Agemy. Today's topic is timing the market or time in the market. Which is it? Well, we say neither. But dividends and income is the key. And then you don't have to worry about what the market's doing. So with that, you can have the first 5 first-time callers at 800-725-7616 for your book, Financial Insanity. It's out of print, but we got some copies for you. Call now, 800-725-7616.
You're locked on to Financial Strategy with Andrew and Daniel Agemy.
Being my 4th decade in this business, I've seen things over and over again. And as you alluded to, Daniel, earlier, history repeats itself. The reason history repeats itself because the thing that does not change throughout history, everything changes in history except people. So people are the same. So here's what's happened throughout, as I said, I'm in my 4th decade in this business, and I've seen this over and over again, whether it was what happened in 1987, it was what happened in 1991, it was what happened in 2000, it was what happened in 2008, it's what happened in 2020, whatever it is. I see this happening so many times where people, they go into the market. Let's say 2020, or excuse me, the year 2000, the market hit high. 11,700 in the year 2000. Well, in 1999, people were going into the stock market that a year later they had lost money. And the egregious thing is that they pulled it out at that point. They bought high and sold low. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about timing the market or time in the market, and which is the right way to do. And if you've been listening, you understand that we say neither, right? Neither.
Right.
Go with
Right.
the pay me model. Go with
Right.
that because especially where things are with stock markets, right? US stock markets, especially by every metric you look at, they are extremely expensive.
Right.
Make your own rules, especially if you're close to retirement. Make your own rules. Do the joyful model, right? Do the model that pays you, that allows you to buy a new car, that allows you to travel, that allows you to maintain your lifestyle in good markets and bad markets.
Right. 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 And that's the papers we're giving away today will help educate our listeners even further than what we're going through right now. Right now, we're trying to give the 30,000-foot view of what we're talking about. That these papers will precisely help people understand. And Daniel, I started off with that story because when you're talking about timing the market is the idea of buying low, selling high. But you never know when is low and when is high. You're never going to buy at the bottom on purpose. You're never going to sell at the peak on purpose. So the idea when you're doing that is you have to buy while it's low and sell while it's high if you're going to do that. But if you're investing for dividends and income, you don't have to worry about that because you're always buying. If you don't need the money, you're always buying. And if you do need the money because you're retired, well, then you can just take that money and you don't have to worry about what your investment is worth. Like the illustration at the beginning of the last segment with the farmland, right? So, but the philosophy, like any business or the stock market, buy low, sell high, is the theory. And it's easy, but it's not simple. That's the whole point. You can't do it. Mm-hmm. So what ends up happening, because people are the same from generation to generation, they invest on emotions and they buy high because, the market's been going up and I need to buy. And then the market drops and they go, I'm scared. And then they pull out, right? So they buy high and they sell low. They do just the opposite of what you're supposed to do. So timing the market is ridiculous. And if you're going to go into market from that angle, that goes along with our book today, right? That's financial insanity. That's what that is, right? And so with that, that's where we're suggesting, and we don't have much time left in the show today. This has been going by real fast. I've been having a good time. How about you, Daniel?
Yeah, it's nice. It's nice doing this with my dad, It's nice.
So
we're also very blessed to have some amazing clients that we're able to do this, right? We get to choose who we want to work with. We want to help people, but we want to help people that want to be helped.
Right.
And these are the kinds of concepts that we believe in, and everybody doesn't have to believe in these. And that's totally fine. But for the people who do want to believe in these and the people who do believe in the pay me model and the people who want to switch, like people intuitively know this, but it's there's that story about the a guy walks into a circus and there's an elephant and it's tied to a chair. And the guy said, and he says, "Whoa, isn't that dangerous? That the elephant is just tied to this chair. It could just run away." And they say to him, "Well, we used to have when the elephant was small, it was tied to a peg in the ground and it couldn't pull the peg out and it couldn't move. And as it grew up, it stopped trying because it thought it was tethered to a peg that it could not pull out of the ground. And now it's tied to a chair and it won't move the chair. Even though it's this big, strong elephant, it will not move the chair because it believes it cannot move the chair. And that's what's happened to investors is they've invested so long in a certain way. They believe, they intuitively know that there's something off about I'm at retirement age and I don't want to take this risk, but what are the alternatives? But that there's no one who is getting paid to buy individual, right, individual things that pay you. There's not a big Wall Street firm. Well, I mean, I'm sure there are, but like, there's not BlackRock. There's not one of these companies that wants you to that's lobbying for these types of funds that you put your money in and stay in there forever, right?
Right.
And so that's what this show is about, and that's why we're so blessed, is because we have clients that give us the opportunity to have this show, so we can
Right.
hopefully benefit the people listening.
Exactly. And I know, the people listening to us, Daniel, I know that they want to know what they don't know. That's why they're listening, right? They wouldn't be listening if they weren't. And, some of those we're helping some of those just by educating them with this, which is great, right? And some of them might want us to help them solve their problems, and some may not, and that's all fine. And we may choose to work with some, and we may choose not to, which is all fine. But the thing that gives me such warmth in my heart is we're adding value to the lives of people by helping them to know what they don't know. You're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. We want you to understand things that you're not going to hear from Wall Street types. And today's topic is timing the market or time in the market. And we have a paper that we'd love to give you that goes along with today's show. It's called Investing for Income in the Stock Market. So you can make money in the stock market. You can make money in general with your portfolio, but you can't do it in the traditional fashion, of just the stock market thing. The answer is not just the stock. That's the easy way, but it's not simple. And so we'd love to put this paper in your hand. Call us at 800-725-7616 for your free copy. Daniel, we have just a few minutes left. We talked about risk, and people want to lower. What I find is that people in and close to retirement are at lower risk, want to invest with lesser risk than they did in the past. People who are aggressive in the past say they're moderate now. People who were moderately aggressive in the past say that they're conservatively moderate now, and so forth and so on, right? And these things that we're bringing across, I love what you brought up today about the risk versus reward scenario. If you can put your money, make 5% on your money at no risk in a US Treasury versus risking it in the market and make 7 to 9% maybe, but lose 20%, 30%, 40%. Is that really worth the risk? No, I don't think so. Not for the retiree, especially maybe for a 20-year-old, 30-year-old. But I love that. And the crux of today's show is the idea of there's other ways to invest besides the stock market. There's alternatives. And these are things that people did in the 50s and the 60s and the 70s during the bear markets that we had in the past. And it worked well for them. It worked well for the parents of our clients, and it will work well for our clients. It will work well for the parents of our listeners. It will work well for them.
Yeah, it's we did a show on this last week about passive income, and it's a passive strategy where you can sit back, and these individual companies, diversified, right? In the crazy times we're in right now, you have to be extremely diversified. Not only people think diversification is I own a bunch of mutual funds that own a bunch of stuff, and it's all the same asset class. It's mutual funds, it's ETFs, it's all the same. It's all going to act the same in any market condition because it's all the same thing. So different asset classes that give you this diversification, but also pay you. And then you can get things that will pay you in different situations. So like you can have securities that pay you bigger dividends if rates are rising. It works like an adjustable mortgage, right? So they pay you larger.
Nice. I
Great.
love it.
They pay you a larger dividend when rates are higher.
Wow.
And you don't have everything in that because rates might go lower. But it's this diversification so you can benefit from each type of market situation.
Daniel, you were talking when we were preparing for this show, you were talking about, giving an example of how some of those things work and how you can watch them and get out of them, get into them, and put the people in a better position. You went somewhat a little bit specifically. Would you like to give that example?
Yeah. It's what I like to call it's a passive strategy. So like you could just sit back and these things pay you, and you can collect the dividends. They can reinvest into the same stuff, but it's a passive strategy while taking advantage of market opportunities. So you can add alpha, right? If you have a manager that understands how to do this, you can add alpha. So let's say the passive, you just sit back and you earn 6%. Well, if you have someone who understands the value of these things, we also call it treasure hunting. You can do like what you were talking about with the land, where you buy the $1 million property for 800,000. Now you know you're going to collect all the money from your crops, but you also know you're going to earn that 20% when it goes back up to $1 million. Now, with especially bonds, corporate bonds, right? This is on a contract. So it's not like when it comes back like the stock market, or stock markets always come back. It's a contract. They're going to buy it back from you, and you know when they're going to buy it back from you. So worst case scenarios, you wait and you collect that 20% when they buy it back. So then when it comes over the 20%, let's say it's 10% over. So you made 30, right? You bought it at 800, now it's trading 10% over par. You sell out of it. Cool. You don't wait for them to buy it back from you. You sell out of it. And now you're having this opportunistically taking advantage of the market opportunities. And it's kind of mixing time in the market, but it's not time in the market. You're sitting there getting paid the whole time. And then you kind of mix in what people like to do, this trading, but it's not trading on like hope and speculation. It's trading on, I know this is above par, so why would I wait for them to buy it back for me at a lower number? I'm going to trade out of it. And you can tag in another 2 to 3% on top of that over time, and that compounds. That's compounding for you. And this is an amazing thing where you have the passive strategy, but you're opportunistically taking advantage of the opportunities that are presenting themselves.
Beautiful. Oh, I love that. I love that strategy. And there's a huge difference between strategies and plans. I think we did a show on that. If we didn't, we're going to, right? But strategies, that strategy is significant because it will compound people's money to where it will grow the old-fashioned way through dividends and interest and put them in a better position so that they don't run out of money before they run out of life. You're listening to Financial Strategies with Andrew and Daniel Agemy. It's been great to be with you today. We have this book for you, Financial Insanity, How to Keep Wall Street's Cancer from Spreading to Your Portfolio, by a friend David Scranton. Easy read book that's out of print, but love to put it in your hands. Only about 100 pages, a little over. And you can have that for free by calling us at 800-725-7616. 800-725-7616. Ask for it by name, Financial Insanity, 800-725-7616. If you want your retirement to be stress-free, invest for the I and not the G.